Section 1.1 to 2.2 Understanding the Dollar Index, a comprehensive in-depth analysis. 1.1 Introduction to the Dollar Index. The dollar index, also known as the U.S. Dollar Index, USDX, is a widely recognized measure of the value of the United States dollar relative to a basket of other major currencies. It provides a benchmark for assessing the overall strength or weakness of the U.S. dollar in the foreign exchange market. The dollar index was first introduced in 1973 by the New York Board of Trade, now known as ICE Futures US. It was created to provide a reliable and objective reference point for investors, traders, and policymakers to gauge the dollar's performance against a diversified basket of currencies. The basket of currencies included in the dollar index has evolved over time, but it typically consists of 6 major currencies: the euro, Japanese yen, JPY, British pound sterling, GBP, Canadian dollar, CAD, Swedish krona, SEK, and Swiss franc, CHF. These currencies are chosen based on their significant trade volumes and economic importance with the United States. The dollar index is calculated as a weighted geometric mean of the exchange rates between the US dollar and the currencies in the basket. Each currency's weight is determined by its importance in US trade. The weights are periodically reviewed and adjusted to reflect changing trade patterns. The purpose of the dollar index is to provide a comprehensive and objective measure of the U.S. dollar's performance against a diversified set of currencies. It serves several important functions. Performance benchmark. The dollar index serves as a benchmark for investors and traders to assess the performance of their U.S. dollar-denominated investments, such as stocks, bonds, or commodities. Changes in the index can indicate whether the U.S. dollar is strengthening or weakening against the basket of currencies. Risk management. The dollar index helps market participants manage currency risk. It allows investors and businesses to monitor the impact of currency fluctuations on their international trade, investments, and financial positions. Monetary policy analysis. Central banks and policymakers use the dollar index to evaluate the effectiveness of their monetary policies and gauge the impact of currency movements on their domestic economies. It provides insights into the competitiveness of a country's exports and imports. Global economic indicators. The dollar index is often considered a barometer of global economic sentiment. When the U.S. dollar strengthens, it may indicate a flight to safety or reflect positive economic conditions in the United States. Conversely, a weakening U.S. dollar may suggest global economic concerns or increased risk appetite. It's important to note that the dollar index focuses on the U.S. dollar's value against a specific basket of currencies and may not capture its performance against other currencies not included in the index. Other currency indexes, such as the trade-weighted U.S. dollar index, provide alternative measures for assessing the dollar's value using different trade weights or currency baskets. The U.S. dollar holds significant importance in global trade and finance for several reasons. Reserve currency. The U.S. dollar is the world's primary reserve currency. Many central banks and governments hold U.S. dollar reserves as a means of stabilizing their own currencies and facilitating international transactions. This status gives the U.S. dollar a unique role in global finance and provides the United States with certain economic advantages. Global trade. The U.S. dollar is the most widely accepted currency for international trade. It is commonly used as a medium of exchange for commodities such as oil, gold, and other major goods. Most international contracts, invoices, and transactions are denominated in U.S. dollars, making it the dominant currency for global commerce. Financial markets. The U.S. dollar plays a central role in global financial markets. It serves as the primary currency for foreign exchange transactions, accounting for the majority of daily forex trading volume. Many major financial instruments, such as government bonds and commodities, are priced and traded in U.S. dollars. The dollar's importance in financial markets stems from the size and liquidity of the U.S. economy, safe haven asset. During times of economic uncertainty or geopolitical instability, the U.S. dollar often serves as a safe haven asset. Investors seek the relative stability and liquidity of the U.S. dollar, leading to increased demand and appreciation of the currency. This safe haven status further solidifies the dollar's importance in global markets. Influence on global monetary policy. As the dominant global currency, the U.S. dollar can exert influence over global monetary policy. Changes in U.S. interest rates and monetary policy decisions by the U.S. Federal Reserve can have significant impacts on financial conditions and exchange rates worldwide. Central banks of other countries often monitor and respond to U.S. monetary policy decisions to manage their own economies. Dollarization. Some countries, particularly smaller economies or those experiencing economic instability, choose to adopt the U.S. dollar as their official currency. This practice, known as dollarization, provides stability and credibility to these economies, facilitates trade and investment, and reduces exchange rate volatility. It's important to note that while the US dollar holds a prominent position in global trade and finance, other currencies, such as the euro, yen, and yuan, are also gaining influence. The dynamics of the global currency landscape continue to evolve, and the relative importance of currencies may change over time. 1.2 Construction of the Dollar Index. The composition of the dollar index, which measures the value of the US dollar against a basket of currencies, has evolved over time. Currently, the dollar index includes the following 6 major currencies. Euro. The euro is the official currency of the European Union and is used by 19 of its member states. It is the second most widely held reserve currency and has a significant impact on global financial markets. Japanese yen. JPY. The yen is the official currency of Japan and is known for its safe haven status. It is one of the most traded currencies in the world and plays a crucial role in global carry trades and investment flows. British pound sterling. GBP. The pound sterling is the official currency of the United Kingdom. It has a long history as an international currency and is widely traded in the foreign exchange market. Canadian dollar. CAD. The Canadian dollar, also known as the loonie, is the official currency of Canada. It is closely tied to commodity prices, particularly oil, due to Canada's significant natural resource exports. Swedish krona. SEK. The krona is the official currency of Sweden. While Sweden is not part of the Eurozone, the Swedish krona is an important currency in European financial markets. Swiss franc. CHF. The Swiss franc is the official currency of Switzerland. It is renowned for its stability and is often considered a safe haven currency during times of market uncertainty. These 6 currencies represent major trading partners and economic powers, and their inclusion in the dollar index helps provide a comprehensive measure of the US dollar's performance against a diversified basket. The weights assigned to each currency in the index are determined based on their importance in US trade, and these weights are periodically reviewed and adjusted to reflect changing trade patterns and economic dynamics. It's worth noting that the specific composition of the dollar index can change over time. The selection of currencies and their weights are subject to periodic review and adjustment by the organizations responsible for calculating and maintaining the index. The dollar index employs a weighting methodology to determine the influence of each currency in the index and calculate the overall value of the US dollar against the basket of currencies. The weights assigned to each currency reflect their importance in US trade. The specific weighting methodology used in the dollar index is based on the trade weights of the included currencies. The weights are determined by considering both the level of trade between the United States and the respective countries and the importance of those countries in the global economy. The weighting methodology typically involves analyzing trade data, such as imports and exports, between the United States and the countries represented in the index. The trade volumes are used as a basis to determine the weights assigned to each currency. Currencies from countries with larger trade volumes with the United States generally have a higher weight in the index. The weights assigned to the currencies are periodically reviewed and adjusted to reflect changes in trade patterns and economic dynamics. As economies and trade relationships evolve, the weights may be modified to ensure that the index accurately represents the relative importance of each currency in U.S. trade. The impact of each currency on the dollar index is directly related to its weight. Currencies with higher weights have a larger influence on the overall value of the index. Changes in the exchange rates of currencies with higher weights will have a more significant effect on the dollar index compared to currencies with lower weights. For example, if the euro, which typically has a significant weight in the dollar index, strengthens against the US dollar, it will exert upward pressure on the index. Conversely, if the Japanese yen, another currency with a notable weight, weakens against the US dollar, it will contribute to a decline in the index. It's important to note that the impact of each currency on the dollar index can change over time as trade patterns and economic relationships evolve. Therefore, the weighting methodology is periodically reviewed and adjusted to reflect these changes and ensure the accuracy and relevance of the index. Section 2, Calculation and Interpretation, 2.1 Weighting Methodologies. The weighting methodologies used in calculating the dollar index can vary, and different approaches have been employed over time. While the specific methodology for the dollar index has primarily focused on trade-based weights, alternative weighting methodologies, such as GDP-based weights, have been proposed and used in other currency indexes. Let's explore these two approaches. Trade-based weights. The most commonly used weighting methodology in the dollar index is based on trade volumes between the United States and the countries included in the index. This approach assigns weights to each currency based on the level of trade between the United States and the respective countries. Currencies from countries with larger trade volumes with the United States are given higher weights in the index. This methodology reflects the economic importance of trade relationships and aims to capture the currencies most influential in U.S. trade. GDP-based weights. In contrast to trade-based weights, GDP-based weights consider the size of each country's economy in determining the weighting in the index. This approach assigns weights based on the relative GDP of the countries represented in the index. The rationale behind using GDP as a weighting factor is that larger economies may have a greater impact on the global economy and, consequently, on currency movements. However, GDP-based weights are less commonly used in the dollar index specifically, and are more often applied in other currency indexes, such as the IMF's Special Drawing Rights (SDR) basket. Both trade-based and GDP-based weighting methodologies have their advantages and limitations. Trade-based weights directly reflect the economic interdependencies between countries and can capture the influence of trade flows on currency movements. However, they may overlook factors such as financial flows or the relative importance of economies beyond trade. On the other hand, GDP-based weights provide a broader view of economic significance but may not fully capture the intricacies of trade relationships. Ultimately, the choice of weighting methodology depends on the objectives of the index and the specific factors considered important by the index provider. The dollar index has primarily used trade-based weights as they align with its purpose of measuring the value of the US dollar against a basket of currencies that are relevant in US trade. Both trade-based and GDP-based weighting methodologies have their advantages and limitations. Let's examine them in more detail. Trade-based weights, advantages, reflects economic interdependencies. Trade-based weights directly consider the level of trade between the United States and the countries included in the index. This reflects the economic interdependencies and the impact of trade flows on currency movements. Relevance to commercial transactions. Since the dollar index aims to measure the US dollar's value in trade, using trade-based weights ensures that the index reflects the currencies most influential in US commercial transactions. Timely and frequent updates. Trade data is regularly reported, allowing for relatively frequent updates and adjustments to the weighting methodology based on current trade patterns. Limitations, excludes financial flows. Trade-based weights may overlook the impact of financial flows and other factors that influence currency movements, such as capital flows, investments, and market sentiment. These factors can have a significant influence on currency values. Especially in the short term, limited scope, trade-based weights may not fully capture the relative economic importance of countries beyond trade. Factors such as the size of economies or their influence in global financial markets might not be fully represented in the weighting methodology. Sensitivity to trade dynamics. The weighting methodology based on trade volumes can be sensitive to changes in trade patterns. Shifting trade relationships or fluctuations in trade volumes can impact the weights assigned to currencies, potentially affecting the representation of the index. GDP-based weights, advantages, broader economic significance. GDP-based weights provide a broader view of economic significance by considering the relative size of economies. Larger economies may have a greater impact on global economic conditions and, consequently, on currency movements. Stability and long-term perspective. GDP-based weights tend to be more stable over time compared to trade-based weights, as they are influenced by long-term economic fundamentals rather than short-term trade fluctuations. Limitations, limited focus on trade. GDP-based weights may not fully capture the impact of trade flows and commercial transactions on currency values. This limitation can be significant for a currency index like the dollar index, which aims to measure the US dollar's performance in trade. Challenges of data accuracy and consistency. GDP data can be subject to revisions and variations in methodologies used by different countries, leading to potential inconsistencies and challenges in calculating accurate weights. Ignoring other factors, GDP-based weights may not account for other influential factors such as financial flows, market sentiment, or the relative importance of currencies in global financial markets, which can impact currency values. The choice of weighting methodology depends on the specific objectives of the index and the factors considered most relevant by the index provider. In the case of the dollar index, the trade-based weighting methodology aligns with its purpose of measuring the US dollar's value in trade and the currencies most influential in US trade relationships. 2.2 Interpretation of the dollar index. The value of the dollar index provides insights into the relative strength or weakness of the US dollar against the basket of currencies included in the index. Changes in the index value have implications for various stakeholders and can impact different aspects of the economy. Currency markets. The dollar index serves as an important benchmark for currency traders and investors. A higher index value indicates that the US dollar has strengthened against the basket of currencies, suggesting a relative increase in demand or confidence in the US dollar. Conversely, a lower index value suggests a weaker US dollar compared to the basket of currencies. International trade. The value of the dollar index can influence international trade dynamics. A stronger US dollar, as indicated by a higher index value, can make US exports relatively more expensive and imports relatively cheaper, potentially impacting the competitiveness of American goods and services in international markets. On the other hand, a weaker US dollar, reflected in a lower index value, may enhance the competitiveness of US exports and potentially stimulate export-oriented industries. Inflation and import prices. Changes in the value of the dollar index can impact inflation and import prices. A stronger US dollar can lead to lower import prices, as it takes fewer dollars to purchase goods and services from other countries. This can contribute to lower inflationary pressures in the domestic economy. Conversely, a weaker US dollar can lead to higher import prices, potentially putting upward pressure on inflation. Monetary policy considerations. Central banks, including the US Federal Reserve, monitor the value of the dollar index as part of their monetary policy considerations. A strengthening or weakening US dollar can have implications for domestic monetary policy decisions. For instance, a rapidly strengthening US dollar may weigh on inflationary pressures, potentially influencing the timing and pace of interest rate changes. Investor sentiment and risk appetite. The value of the dollar index can reflect global investor sentiment and risk appetite. In times of uncertainty or market stress, investors often seek the relative stability and liquidity of the US dollar, leading to an increase in demand and potentially strengthening the currency. Conversely, during periods of improved market sentiment and higher risk appetite, investors may move away from the US dollar, potentially weakening its value. It's important to note that the dollar index is just one indicator of the US dollar's value and should be considered alongside other economic indicators and factors that influence currency markets. Additionally, the impact of the dollar index can vary depending on specific economic conditions, geopolitical events, and other global factors. Changes in the dollar index can reflect broader market sentiment and economic trends in several ways. Risk appetite. The dollar index is often considered a gauge of global risk sentiment. During times of increased uncertainty or market stress, investors tend to seek the relative safety and liquidity of the US dollar, leading to a higher demand for the currency and potentially driving up the index value. Conversely, when market sentiment improves and risk appetite rises, investors may shift away from the US dollar, potentially resulting in a lower index value. Therefore, changes in the dollar index can indicate shifts in market sentiment and investors' perception of risk. Economic strength. The dollar index can reflect the relative economic strength of the United States compared to other countries. A strong U.S. economy, characterized by robust economic growth, low unemployment, and stable inflation, can attract investors to the US dollar and potentially drive up the index value. On the other hand, economic weaknesses or uncertainties may lead to a weaker US dollar and a lower index value. Changes in the dollar index can therefore provide insights into economic trends and the relative performance of the U.S. economy compared to other economies. Interest rate expectations. The dollar index is sensitive to interest rate differentials and expectations. Higher interest rates in the United States, relative to other countries, can attract foreign investors seeking higher returns, thereby increasing demand for the U.S. dollar and potentially driving up the index value. Conversely, expectations of lower interest rates or diverging monetary policies between the United States and other countries can lead to a weaker U.S. dollar and a lower index value. Changes in the dollar index can therefore reflect market expectations regarding monetary policy and interest rate differentials, trade and economic relations. The dollar index can also reflect changes in trade and economic relations between the United States and its trading partners. For example, trade tensions, policy shifts, or changes in global trade patterns can impact the value of the U.S. dollar against other currencies and influence the dollar index. Moreover, economic developments and events in major trading partner countries can also affect the value of the U.S. dollar and, consequently, the index. Commodity prices. Changes in commodity prices, particularly for commodities priced in U.S. dollars, can impact the dollar index. For instance, a rise in commodity prices, such as oil or gold, can lead to increased demand for the U.S. dollar, as these commodities are commonly traded in U.S. dollars. This increased demand can potentially drive up the index value. Conversely, falling commodity prices may reduce demand for the U.S. dollar and contribute to a lower index value. It's important to note that while the dollar index provides insights into market sentiment and economic trends, it is just one indicator among many, and a comprehensive analysis requires considering multiple factors and indicators to understand the broader market dynamics and economic conditions.